Hi, I'm Fiona Boyd, U.S. Director of Acuity Commodities. Thank you for joining us for our second podcast episode, and thank you to our listeners for your encouragement to keep it going. We're recording this on Thursday, July 17th. We've just returned from some industry events, and we will discuss key takeaways as well as touching on some current market conditions.
We just returned from the Southwestern Fertilizer Conference in Nashville, Tennessee, where we talked with industry participants in the fertilizer industry and had some really good conversations there. And we also went to the Fastmarkets conference in Las Vegas, Nevada, and it was a lithium battery materials conference. So I just kind of wanted to talk more about that and some talking points and key conversations that we had there. There was definitely a lot of interest in the chemical reagent markets that we cover, especially from participants in that sector that are looking at, their potential projects coming online and operating expenditures for their chemical input requirements. So I think there was a good amount of interest spurred, and I would just say the overall kind of tone that I got from the conference was a little bit of kind of a bearish sentiment still from that sector. For
lithium particularly, right? You were mentioning that at Southwestern absolutely. When people wanted to hear about what was happening in that space, Right,
which kind of just clouds the outlook for a lot of these projects, right?
And what is the more bearish sentiment being driven by?
I would say overall, it's kind of the lack of investment that's a result of kind of the low pricing environment that we're seeing in lithium pricing today. And a lot of that has been spurred by kind of oversupply on the global market, a lot of which, is attributed to capacity in Asia, especially, as, they kind of look through their demand for energy storage and changing battery chemistries, which we can get into, as well as, different extraction technologies, bringing to light resources in different regions as well. So it's still a kind of a story of, when will this lithium price environment kind of return to levels that we've seen in the past? Like 2022 was a great example of that. And I think that was referenced at the conference quite a bit as, maybe as we talked about in the last episode, the EV adoption was slower than expected, bringing on not as much demand up to this point since 22. And, how it's going to look going forward, as, some of these gigafactories come online, as energy storage capacity increases come, and what the changing chemistries will mean for that. And for us as kind of outsiders looking into this industry, since we don't really cover the lithium markets, right? We're more interested in, the kind
inputs,
the inputs, the reagents, sulphuric acid being a key one, right? It's kind of like, it's a difficult scenario to navigate, right? So that's why we're trying to have these conversations now and really figure out what the outlook might look like.
Right. And let's talk a little bit about the EV kind of slowdown, right? And that was a lot of talk even at a fertilizer conference, was as you take away subsidies, whether that's in Europe or the US, that, incentivize people to buy electric vehicles. So those are starting to go away. And I feel like now a topic that is more kind of overshadowing that, as you touched on, is energy storage, and AI, and how many, we need all this energy to power these computers. So, it seems like the demand for lithium will be there. It's just more now like what's the outlook for the applications, right? And specifically, like you said, on the battery chemistry, changing technology.
Yeah, I definitely agree. And I think that it's key to talk about that regionality, kind of like you mentioned first, right? I mean, I think that during the conference, there were a lot of conversations had, and to their credit, Fastmarkets does a really great job of laying out the land and these giving outlooks in these regions and how much of this capacity, is coming online for, potential manufacturers of EVs. And by region, the growth rates were definitely the strongest in Asia, largely China. Secondly, Europe, and then the US being, kind of behind, as we mentioned in the last episode, right? So again, it's looking at that and, going, when is this kind of growth rate going to maybe start to see some uptick in adoption, and what the differences are and the nuances in those markets, right? If you start with China, you're looking at basically the cost of production much lower than other regions, pricing for EVs much more affordable than the balance of the other two being Europe or the US. And also charging infrastructure plays a role there too, right? I mean, plenty more charging infrastructure capacity there.
I've seen reports saying like a ninefold needed expansion in like a very short amount of time, which just doesn't seem feasible. And again, I think that continues to kind of tie in, at least in the US, to the skepticism of the EVs is right, charging infrastructure, battery life.
And as you mentioned, the other key piece of that is the policy and regulation. And in the US, it almost feels like sometimes every 4 years we get like a complete 180 on things. So that was a huge topic at the conference, right? And what that's going to look like moving forward. I think some positives from that on the permitting side were, the Fast 41 permitting projects and trying to lower the barriers to entry for, some of these mining and industrial projects that are, trying to get these projects permitted in a timely manner. So I think that was definitely a positive. I think on the negative side, there was at the time before the Big Beautiful Bill was kind of in the making. There was just talk around, what is the kind of rollback from the IRA going to look like and how that's going to affect the subsidies for some of these projects, or, even the outlook for DOE loan funding moving forward and its strategy for, these projects as well. So, just a lot of uncertainty there. And now that we've gotten a little bit of clarity on the Big Beautiful Bill, it's important to note that, the EV tax credits rolled back not only on the consumer end, but also the producer end. So definitely, the political kind of fuel for that fire has dimmed a bit. And I also think, what you see on the political landscape on the global scale also is going to be important for projects moving forward, right? So we'll see how that continues to look. But at the same time, you also mentioned a key point, which was storage capacity needed, especially for energy storage applications outside of EVs, right?
Correct.
It's for any industrial projects that, need the storage for electricity, for AI data centers, for, and that's artificial intelligence data centers, I should say. And, all kinds of applications, even, power plants, renewables, just energy storage for electricity, and what that's going to look like moving forward. And I think Fastmarkets did a really good job of, laying the land in that landscape in their presentations throughout the conference. And basically Fastmarkets was kind of signaling that the demand growth on gigawatt hours for basically the global landscape through 2035 is supposed to increase fourfold.
Okay.
So that's including, all of this energy storage of electricity, more related to the grid, right? So we'll see if these things come to fruition. Will that have an impact on lithium price for this demand and kind of spur that commodity cycle a little bit better? But for now, it kind of remains in a bit of a holding pattern, I think.
Fair enough. Well, any final comments on Fastmarkets or kind of the metal space before we?
Yeah, there was a lot of talk about changing battery chemistry,
Right.
which we talked a little bit about in the previous episode, and the lithium sulfur battery announcements in the US and even in some other regions since. So I think there was definitely a strong sentiment towards lithium iron phosphate batteries.
Right.
And the LFP, lithium iron phosphate battery, is different than kind of the conventional technology being nickel, manganese, cobalt batteries. And obviously uses different inputs, right?
Right.
So I think...
And we've really seen like production in China grow, right?
Exactly.
And that's where it's centered.
And that's the key point, right? And Fastmarkets actually says that the LFP production in China grew 124% annually from 2020 to 2024. Wow. Which is just a massive uptick, right? Especially in such a short amount of time. And it is such a new technology, right? Just was cutting edge at the time in 2020. And now here we are, 5 years later, and capacity is looking much greater than it was before. Right. And now it seems like from the Fastmarkets outlook and forecast that the LFP battery is really set to overtake the former nickel, manganese, cobalt batteries as the adopted technology for EV manufacturers.
Which then, of course, would have a knock-on effect for cobalt and nickel markets.
Precisely.
So, right.
Not to say that there's not still demand for the base metal markets in other regions and other sectors
and other applications, yeah.
But that is definitely something to watch. And it's also notable at the conference was other battery chemistries as well. Sodium ion, vanadium redox. Like there's a lot of different things in development that, again, if adopted, could even overtake LFP, could even overtake more nickel, manganese, cobalt battery capacity. So,
and it's all this so new and evolving, and that's where we're trying to step in to provide, at least on the downstream, where is the demand really going? What are we seeing?
It's key to understand these things, and it really impacts the global market. It impacts the regional markets, and there's such disconnection between them.
Yeah, so and it's kind of, almost, I feel I've been saying this for 2 years, kind of being in this holding pattern, right? Where we're waiting for new demand to emerge. But we are seeing it now in Indonesia. Nickel, sulphur imports there have risen dramatically as they start up new burners. And that's, really kind of changed the market landscape too for sulphur this year, at least. More competition between metals versus traditional phosphate fertilizer producers.
Right, which was a key topic of conversation at the Southwestern Fertilizer Conference.
Yes, so we got back from Nashville just yesterday, and there was a lot of discussion about the phosphate, price environment. What we're seeing is, overall global lower phosphate production in various regions is really helping support phosphate prices. But at the same time, we're not seeing grain prices firm as much alongside. So, some of us in the market might remember July 2022, phosphate prices were very high, sulfur prices were very high, but the difference then was that grain prices were super high. So we're more and more chatter about farmer affordability globally and domestically. Globally, for example, Pakistan is known to be buying more TSP from OCP Morocco than, more traditional DAP MAP products. And TSP actually uses less sulfur. So, there are some knock-on effects. And then domestically, while, the supply chain for fertilizers is pretty empty, there's expectations that we'll see a lot of delayed or just-in-time buying because of the price environment. Will it be demand destruction? That's yet to be seen. But again, more discussion around that affordability, particularly at a time when, sulfur pricing, at least on a Tampa basis, is still, pretty elevated compared to the last few years. And also the ammonia price outlook is stronger for this year, like
Absolutely.
you'll discuss later. So,
absolutely. Do you have any thoughts on kind of, I guess, the phosphate market maybe moving forward from what we picked up at the conference?
I think it is really just going to depend on that fall demand, at least domestically. We're expecting an improvement in exports from China. So, but that didn't have much of an impact when we were in the first tranche. So, if that happens, will that reduce phosphate prices? But then also a knock-on effect of increasing sulfur demand potentially in China. So
right.
That's something we're waiting to see.
Right. Definitely a lot of questions to be had out there. And I think, jumping back into our key markets, since we had a lot of conversations, around sulfur and sulphuric acid and, some developments since our previous episode. Just getting into sulfur, how are you kind of seeing the sulfur market right now? Obviously, since our last episode, we had the settlement of the third quarter Tampa contract at $252 per long ton delivered. So a little bit of a decrease from the second quarter. Where are you seeing, I guess, the sulfur market right now?
I do expect, I expect to see the Tampa settlement for fourth quarter lower. I would say outside of any kind of notable supply destruction, such as, as maybe a hurricane came through the Gulf. But at the same time, that could also impact consuming operations. But, globally, we've really just kind of seen that continued slowdown in interest in China and Indonesia, which is really, probably mentioned in the last episode, which was what was driving kind of the bull run in pricing. And we talked about, phosphates and affordability and, China's exports and all of that. But then also for Indonesia, there's also, discussion around affordability because of nickel pricing. They have increased, royalty system domestically. So yeah, we're just really not seeing that sustained buying demand. And the fact that July posted prices by Middle East producers showed reductions over June at a time when there was conflict in that region, to me is a reflection that, it was not a supply-driven kind of price pop.
Right. That was definitely interesting to see. Did you have any other thoughts on the sulfur market lately or anything that we heard at the conference?
There continues to just be ongoing discussion around declining production in the U.S., in, the continued potential for new demand and how that could change, trade flows on a North American basis. The market's unique. So we see molten exports to Europe. We see solid coming in from the Middle East. We're importing molten from Canada. We're seeing solid coming out of Vancouver. So how all of that will kind of shift and take place on a longer term basis remains a key point of discussion.
Absolutely. And as we talked about last time, always tariffs in kind of the background.
Tariffs. And for sulfur, it's not as much as the impact directly, right? I mean, maybe on the downstream or the related markets, except, of course, since that sulfur we're importing from Canada is USMCA compliant. But it is more of an issue on the sulphuric acid side in terms of, and we'll talk about that a little bit in terms of the tariff impact for import buyers and how that could impact the market going into next year.
Yeah. And since we're here now, if that's kind of it from your end on sulfur, is it okay if we move on to sulphuric acid? Then I guess let's just start kind of where you left off there, since there was a lot of talk around tariffs and obviously maybe a little bit more impactful for the U.S. market on the sulfuric acid side than the sulfur side. So what does that kind of look like?
So the U.S., is a deficit market for sulfuric acid. We import about 1.8 million tons from Canada, largely by rail, and, at least 500,000 tons from Mexico. It's usually pretty hot. It kind of fluctuates. And that, again, is USMCA compliant, but we do import significant volumes into the Gulf and East Coast from Europe, into California from Asia. So how that is going to be, if tariffs are enforced or updated tariffs are enforced on August 1st, if those stay in place as we go into kind of the domestic bid season, right? Then the question is, how do you price those imports in? The U.S. is a very unique import market, and that what we're bringing in is for distribution against, commitments that suppliers have made. It's not like markets in like Brazil or Chile, where I'm a fertilizer producer importing directly for my consumption, or I'm a copper, leaching operation. It's, this distribution. So that means the domestic contract pricing has to allow for that import pricing. And that could be pretty challenging, as we go into bid season, if that is still, something overhanging in the market.
Right, because that pricing on a yearly basis in the U.S. is typically set around October, November-ish, somewhere in there.
The large bulk, right?
So it's interesting that you note that the U.S. market is kind of sensitive to global spot pricing in that
and disconnected, I would say. And we're seeing that right now. Brazil is, import pricing into Brazil is in the 180s CFR, but that would not work in the U.S. today. So that, again, being a supply deficit market, that's going to, be a key point for next year. So, outside of that, the discussion is around how the market has just been so well supplied this year. We haven't had as many supply disruptions. Demand overall is flat. Imports are down. But the outlook is pretty firm for going later into the year. And that's being driven mainly by new demand in Arizona for copper leaching, as well as some of that coinciding with planned maintenance, throughout kind of the system.
Great. Yeah, I think that's a great outlook for, the global and U.S. market and how those two play and tie in together. Did you have any other, I guess, thoughts or comments on kind of the Western U.S.? I know last episode we were talking about how the West is best.
West continues to be, where we're seeing the firmest demand, right? We discussed in the last episode, pulp and paper closures in the Southeast. So yes, the attention is definitely on that new demand coming up, the existing demand that's stable to support, current mining operations. So yeah, that is providing overall market support. And then, should get more active as the year progresses and maybe turn into the Wild West, according to some market participants.
I'm not sure if I like that better. The West is best or the Wild West?
We'll have to see. So I think that kind of wraps it up on acid. I noted earlier on ammonia that the price outlook was pretty firm for the rest of the year. So what's driving that?
Right.
What are you seeing there?
Right. Definitely is, especially after the Middle East tensions and, some production outages, both in the Middle East and some globally, and turnarounds and maintenance. We're kind of still in that summer season where, a lot of these fertilizer operations for consumption are either taking downtime or their maintenance turnarounds, right? We're at a time where they don't have to produce as much before, filling up inventories for fertilizer. So I think from the conference, it seemed like there wasn't anything super unexpected off the back of that. We had a price response of really firming prices in the Middle East, and it carried over on a global level. And so here we are in, North America, and we had, I would say higher than anticipated summer fill and fall prepay announcements, which obviously impacts retailers and farmers in the U.S. And the farmer affordability that you referenced definitely plays into that. But at the same time, the differential between the summer fill and fall prepay announcements was fairly large, I would say, or at least comparatively. So I guess that means, if farmers are looking to use those ammonia shipments, and they almost always will, right? They kind of need these fertilizers to really grow their production, and it was seen as better for them to buy now than to wait to buy later.
Right.
So
that provided some buying support.
That definitely provided some buying support and some just more comfortable volume commitments, I think, from the farmer level, even amid these concerns around farmer affordability, right? But I think on a certain level, there can only be so much demand destruction that's capable on the farmer level, because they just, like I said, they just need the tonnages to grow that acreage. I think it'll be interesting to see the fall application season goes moving forward, and how ammonia pricing kind of is responding to the global market at the same time. And again, like we mentioned last episode, we've got, capacity that's awaited in the U.S. Gulf Coast.
Right.
I think in Beaumont, basically anticipating first ammonia production as soon as potentially October, signaling to the market, pre-commissioning activities ongoing, construction, maybe 80% plus. So I think that's pretty firm, although I would say another facility in Texas City that has been delaying its capacity for quite some time now has kind of come into question and is just overhanging the market, really.
Right.
And no real clear signal on when that capacity could be commissioned, if it even is. So we'll see how this new capacity plays out, and if the market is responsive to that on a global and domestic level.
Awesome. Okay, well, I feel like we hit a lot of key points in some markets. Definitely a lot going on, a lot of uncertainty. So
uncertainty is certainly the word.
The key word. So yeah, thank you to our listeners for joining us today. If there's something you would like us to discuss in our next episode, we welcome your feedback.
Yeah. Thank you guys for tuning in. And if you need any more information from Acuity Commodities on our products, services, or to reach out, give feedback, we'd love to hear from you. You could email us at info@acuitycommodities.com. And thanks so much for tuning in.
Thank you.